Imagine booking a flight for $39, showing up at the gate, and learning that the airline that sold you the seat no longer exists. No crew, no plane, no refund line that answers. That is what happened to thousands of travelers on May 2, 2026, the morning Spirit Airlines turned off the lights for good. For 2 decades, Spirit sold you the cheapest seat in the sky and then charged you for everything else. The bag, the water, the right to sit next to your own child. It was the airline everyone loved to mock and kept booking anyway. At its peak, it was the largest ultra-low-cost carrier in America, and a rival offered $3.8 billion to own it. Then it filed for bankruptcy. Twice. This is the story of how an airline that stripped every fare down to the bone was finally stripped down to nothing and sold for parts. Spirit was not always a punchline. It began as a trucking company in 1964, became a charter operation, and by the early 2000s it was a conventional carrier losing money the conventional way. The turn came in 2007, when a new chief executive named Ben Baldanza looked at the business and made a decision that would define an entire era of air travel. He decided Spirit would stop pretending. Every other airline bundled a fare, a seat, a bag, a drink, and a smile into one price and pretended the whole thing was about service. Baldanza tore the bundle apart. The ticket would now cover one thing only, a seat on the plane. Everything else carried a price tag. Want to bring a carry-on bag? Pay for it. Want to choose where you sit? Pay for it. Want a cup of water at 30,000 feet? Pay for it. They called it the bear fare, and the industry was horrified. Spirit leaned into the outrage. It ran advertisements mocking its own reputation and treated angry customers as free publicity. And here is the part the critics kept missing. It worked. By pulling the fare apart, Spirit could advertise a headline price lower than anything else on the screen, then earn its real money on the fees the customer never saw coming. The planes flew packed. For a while, the margins were the best in the business. Spirit had turned flying into a vending machine, where the seat was cheap and everything around it cost extra. They sold the illusion of a bargain, and America lined up to buy it. By the late 2010s, Spirit was the fastest-growing airline in the country and the largest ultra-low-cost carrier in the United States. It had taken the model of European discounters and rebuilt it for American skies, and imitators were scrambling to copy it. The yellow planes were everywhere. Spirit carried tens of millions of passengers a year to the beaches and the casinos, and the family reunions that the big carriers had priced out of reach. For a certain kind of traveler, Spirit was not a joke. It was the only way to afford the trip at all. And then came the moment that proved how valuable the model had become. In 2022, 2 of the biggest names in American aviation went to war over the right to buy it. Frontier made a bid. JetBlue, a larger carrier, outbid it. The agreed price was $3.8 billion for an airline that 2 decades earlier had been an afterthought. Wall Street had decided the company that charged you for a glass of water was worth nearly $4 billion. It was the high watermark. It was also the moment Spirit stopped being able to survive on its own. If you are still watching, you are exactly who this channel is for. Bondholder is new, and we are building it from scratch, telling the stories of corporate collapse from the perspective of the people who saw it coming first. The creditors, the bondholders, the ones reading the math while everyone else is still reading the headlines. If that is the kind of story you want more of, hit the subscribe button. You do not just stay in the loop for the next airline that runs out of runway. You help us keep making these. Thank you. But an airline that had stripped every fare down to the bone had nothing left to cut when the debt finally came due. The first thing that broke was the very thing that made Spirit special. For years, the gap between a Spirit fare and a normal fare was the company's entire reason to exist. Then the big carriers noticed. Delta, American, and United rolled out their own stripped-down tickets called Basic Economy that matched Spirit on the headline price while throwing in a brand name, a real network, and a loyalty program. The bargain that built Spirit was suddenly available from Airlines people actually trusted. The price gap closed, and the reason to choose the yellow plane closed with it. The second thing that broke was mechanical, and it was brutal. The engines on a large part of the fleet, geared turbofans built by Pratt Whitney, were found to have a defect that forced them off the wing for long inspections. By the second half of 2025, dozens of Spirit's jets were grounded, parked on the tarmac, earning nothing while the lease payments kept arriving. A bargain airline lives or dies on a single number: how many hours a day it can keep each plane in the air. Spirit's planes were stuck on the ground. The engine that powered the bargain had stopped turning. Frontier, its oldest rival, was fighting the same war and quietly retreating from routes to stay alive. The difference was that Frontier still had a little room to maneuver. Spirit had engineered that room away years earlier. The third blow was the rescue that never came. The federal court blocked the JetBlue merger in early 2024 on the grounds that it would raise fares for the very budget travelers Spirit served. The logic was sound. The consequence was fatal. That merger had been Spirit's exit, the lifeline that would have folded it into a bigger and healthier balance sheet. With the door closed, Spirit was left alone with its debt and its grounded fleet. And there was a quieter problem underneath all of it. Spirit had sold many of its planes and leased them back to raise cash, which felt clever when times were good. But a company that rents its fleet cannot shrink. When demand fell, Spirit could not park planes and cut costs the way an owner could. The fixed bills came due whether the seats sold or not. This is where the creditors entered the story, because they had been watching the math break long before the public did. Back in 2020, when the pandemic emptied the skies, Spirit raised money the way distressed airlines do. It issued senior secured notes paying 8% interest, and to back them it pledged its single most valuable asset. Not its planes, its loyalty program and its brand. The Free Spirit program and the Spirit name were spun into separate subsidiaries and handed to the lenders as collateral. Think about what that means. The lenders did not want the planes. Planes lose value and burn fuel. They wanted the one thing that could not be repossessed and flown away: the customer list and the logo. And the senior creditors were names that specialize in exactly this: Citadel, Airlines, Pacific Investment Management. These are not airline romantics. They are distressed debt investors who buy into broken companies precisely because they have read the documents and know where they sit in line. Long before any headline, the secondary market had been marking those bonds down, the quiet way professionals price a funeral that has not been announced yet. And where they sat was at the very top. So when Spirit filed for bankruptcy the first time in November of 2024, the creditors did not panic. They did the math. They converted $795 million of their debt into ownership, put in $350 million of fresh money, handed themselves the $840 million of new secured notes, installed a new board, and quietly became the airline. The people who had lent Spirit money now owned it outright. For a moment, it looked like a rescue. It was really a test. By the time the stock cleared, the bonds had already taken the company. The test failed. Spirit came out of its first bankruptcy in March of 2025, lighter on paper but flying into the same headwinds. The price gap was still gone. The engines were still grounded. The cash kept draining. 5 months. That is how long the reorganized airline lasted before it was back in front of a bankruptcy judge. The second filing landed at the end of August. This time was worse. One of the biggest aircraft lessors, AerCap, moved to take more than 24 planes back, most already grounded for engine inspections. A credit card processor, nervous about funding an airline that might not survive to fly the trips people had booked, started holding cash back. For an airline, that is the beginning of the end, because cash is the only thing keeping the planes fueled and the crews paid. The liquidity that keeps an airline aloft began to evaporate. Spirit tried one last time. In March of 2026, it filed a plan to cut its debt and lease obligations from $7.4 billion down to roughly $2 billion. It was a reasonable plan. Then a war broke out overseas, jet fuel prices spiked, and the numbers that had barely worked stopped working at all. And then came the strangest twist of the entire story. The federal government offered to step in with a rescue package worth $500 million in exchange for 90% of the airline. For a dying company, that should have been salvation. But the airline was no longer the airlines to give away. The senior creditors held the keys, and they had the right to say no. There were 3 groups of them. 2 were willing to deal, because in a restructuring they stood to recover almost nothing anyway. The 3rd was different. Citadel, Airlines, and a distressed debt specialist called Cyrus Capital sat at the very top of the stack, with hundreds of millions apiece in the most secured debt the airline had. They ran the arithmetic one final time. 90% of a restructured Spirit, flying straight back into the storm that had already grounded it twice, was worth less than selling off the collateral and walking away. All of it was worth more in pieces than the whole was worth alive. The creditors looked at the rescue and they said no. They walked. In the end, the creditors decided the cheapest option was to let it die. Here is what the collapse of Spirit actually proves, and it is not that cheap flying is dead. Cheap flying is fine. The big carriers copied the unbundled fare so completely that today almost every ticket sold in America is a Spirit ticket in disguise, with the bag fee and the seat fee all sold separately. Spirit did not lose because its idea was wrong. Its idea won so completely that it stopped being special. The real lesson is about fragility. Spirit had built a business that depended on one variable above all others, depended on keeping its planes in the air as many hours a day as physically possible. That single number was the whole margin. It left no slack, no reserve, no cushion, and a business with no cushion does not get to choose which crisis kills it. A healthier airline can survive a grounded fleet, or a price war, or a blocked merger, or a fuel spike. Spirit was hit by all 4 at once, and it had spent 20 years engineering away the very fat that might have let it absorb the blow. This is the pattern that turns up again and again in the companies we cover. The tightest operation in the room is usually the one with the least room to be wrong. Strip a business down to pure efficiency, and you have also stripped away its ability to survive a surprise. Spirit unbundled the fare. Then the world unbundled Spirit, one shock at a time, until there was nothing left holding the pieces together. So where did everyone land when the planes finally stopped flying? Spirit turned its second bankruptcy into a Chapter 7 liquidation, the first time a major American airline had been broken up for parts in nearly 20 years. A trustee now sells off what is left, in order of seniority, and the order is everything. The front of the line stand the senior secured creditors. The same Citadel, the same Airlines, the holdouts who refused the rescue. They are first to be paid out of the wreckage, and the wreckage is worth real money. The aircraft and spare engines were valued at around $1.3 billion. The gates and takeoff slots at LaGuardia, another $87 million. Add the parts and the property, and the hard assets came to roughly $1.7 billion, divided from the top down. The creditors who said no to the rescue did so because they had calculated correctly that this pile was worth more than the airline alive. Some of the oldest jets had already been sold off the year before to a company that strips planes down for their components. Below them, the math runs out fast. The vendors, the workers, the passengers holding worthless tickets all stand at the back of a line that will never reach them. And the shareholders, including the very bondholders who had taken equity barely a year earlier, were wiped out completely. The lenders who became owners learned the oldest lesson in finance. Owning the company is only good news if the company is worth owning. The fare always had a catch. And now the only thing left to sell is the airplane itself, one part at a time.